This simple ratio can instantly tell you whether the stock is cheap or expensive. And the man who popularized it, Peter Lynch, one of the greatest investors ever, used it to deliver 29% annual returns for 13 straight years. It's called the PEGY ratio. Once you understand how it works, you'll never look at stocks the same way again. Today, I'll break down not just the PEGY ratio, but also the two other most important valuation ratios every investor should know: PE and PEG. I'll show you how Peter Lynch's genius method can help you find undervalued stocks before anyone else does. Let's start with the basics. The price-to-earnings ratio is probably the most famous valuation metric in investing. It's simple. You take the stock price and divide it by the company's earnings per share. So if a company's stock costs $30 and it earns $3 per share, the PE ratio is 10, which means you are paying $10 for every dollar the company earns. The lower the PE, the cheaper the stock appears. But there is a problem with PE ratios. They don't tell you the whole story. A company with a PE of 30 might actually be cheaper than a company with a PE of 10 if the first company is growing much faster. That's where the PEG ratio comes in. The PEG ratio was initially developed by Mario Farina and later popularized by Peter Lynch. During his legendary run managing the Fidelity Magellan Fund, where he delivered 29% annual returns for 13 years, PEG stands for price-to-earnings growth. Calculate it by taking the PE ratio and dividing it by the company's earnings growth rate. So if a company with a PE of 30 is growing earnings at 30% per year, its PEG ratio is 1. If another company has a PE of 10, but it is only growing at 5% per year, its PEG ratio is 2. Peter Lynch's rule was simple. A PEG ratio below 1 suggests the stock might be undervalued. A PEG above 1 suggests it might be overvalued. But Lynch didn't stop there. He realized there was still one crucial piece missing from this equation. The PEGY ratio is Peter Lynch's masterpiece. It takes the PEG ratio and adds one more factor: the dividend yield. Here's how it works. You take the PE ratio and divide it by the sum of the growth rate plus the dividend yield. So if our company has a PE of 30, is growing at 30% per year, and pays a 3% dividend, the PEGY ratio is 0.9. Lynch believed that this was the most complete picture of a stock's value because it considers price, earnings, growth, and the cash you get back as dividends. Just as with PEG, a PEGY ratio below 1 suggests the stock might be undervalued. The lower the number, the better the potential bargain. What makes the PEGY ratio brilliant is that it rewards companies that not only grow their earnings, but also pay dividends to shareholders. Two companies might have identical PE ratios and growth rates, but the one paying a 4% dividend will have a much better PEGY ratio than the one paying nothing. This makes perfect sense. As an investor, you should value getting cash in your pocket today while you are waiting for the company to grow. Peter Lynch used this approach to find incredible winners like Dunkin' Donuts, Taco Bell, and Home Depot during their early growth phases. So here is the simple framework. First, calculate the PE ratio to get a baseline valuation. Then calculate the PEG ratio to see if the growth justifies the price. Finally, calculate the PEGY ratio to get a complete picture, including dividends. But remember, no single ratio tells the whole story. The PEGY ratio is a fantastic starting point, but you still need to look at the company's financial health, competitive position, and long-term prospects. Price is not everything. You also have to understand the business, its risks, and opportunities.